Welcome back to the deep dive. It is February 12, 2026. If you've been watching the markets this morning, or really any time in the last 6 months, you probably felt it. That, that subtle, almost unnerving shift in the rhythm of the ticker, the way the price action feels just sharper.
Faster?
Faster, yeah. A little less forgiving.
Less human is usually the phrase people use when they try to describe it to me.
That's exactly it. It feels engineered. And, we used to talk about AI trading as this futuristic concept, right?
And one day.
Like one day the robots will handle the portfolio, but we are so far past one day.
We're there. We survived.
We are living in the era where the algorithm isn't just a tool, it's the dominant species in the ecosystem. You have retail traders, people sitting at their kitchen islands with a cup of coffee accessing predictive tools that would have looked like alien technology to a Goldman Sachs floor trader just 4 years ago.
It's the democratization of high-frequency intelligence,
Mm-hmm.
which is incredible.
Mm-hmm.
But it brings us right to the problem we're tackling today.
Right.
Because while everyone knows the AI is making the moves, almost nobody knows how it's making them.
The black box problem.
Exactly. We see the output, buy NVDA, sell Tesla, but the internal logic, the thought process, if you can even call it that.
It's a total mystery.
It's completely opaque. Is it magic? Is it just a lucky guess? Or is there a distinct architectural reason why it made that specific call?
And that is our mission for this deep dive. We are not just going to speculate today. We have a stack of research here, and it's all centered on this massive peer-reviewed study that was just published in the Applied Sciences Journal.
Yeah, this isn't a Medium blog post or some tweet thread.
No, this is a rigorous academic dissection of a brand new deep learning framework designed specifically for high-frequency signal forecasting.
And the headline number from this paper is, I think, going to stop people in their tracks. This framework, in the controlled testing environment, achieved a precision rate of 92.4%.
92.4%. Let's just sit with that for a second. If a human trader told me they had a 92% win rate on directional bets, I would immediately assume they were running a Ponzi scheme.
And you should. That number is statistically absurd for a human being. It's just not possible. But for this specific architecture, it's real.
Wow.
And today, we're going to tear it apart to figure out how. We're going to look at the three brains inside this model, explain how they fuse different kinds of data, and then, and this is the part I really want to get to, we're going to compare this lab-grown Ferrari to the actual cars you can buy today.
The stuff people can actually use.
The stuff people can actually use. We're talking Tickeron, TrendSpider, Interactive Brokers, the whole lot.
So no lecture halls today. We're going peer-to-peer. I just really want to understand how you take a chaotic mess like the stock market, feed it into a computer, and get a 92% accuracy rating out the other side.
It all comes down to structure. It's about how you build the brain. Shall we open the blueprint?
Let's do it. Okay, the paper is titled, and get ready for this, A Deep Learning Framework for High-Frequency Signal Forecasting Based on Graph and Temporal Macro Fusion.
It's a mouthful.
That is a mouthful of jargon.
It is, but every single word in that title is a clue. It's a clue to why all the old models failed.
Okay, explain that. Why were the old models failing? What were they missing?
Think about how we used to model the economy, or even just a stock price. We used linear regression or basic time series models like Aramu.
Right, stuff I learned in stats class.
Exactly. These are tools designed for a linear world. If A happens, then B happens. But the market isn't linear. Not even close. It's chaotic.
It's messy.
It's incredibly messy. So the traditional models fail because they cannot handle three specific things simultaneously.
Okay, what are the three things?
So first, nonlinear relationships, chaos theory stuff, the butterfly effect. A small change over here can cause a massive, unpredictable change over there. Second, complex data structures. Old models couldn't understand that Apple isn't just a stock picker. It's a node that's connected to Microsoft and to Foxconn and to consumer sentiment and to interest rates. It's part of a web.
Okay, and the third?
Multidimensional information. You have to look at the price, the news, and the macroeconomy all at the exact same second. You can't just look at one.
So the old models were like trying to predict a hurricane by only looking at a thermometer.
That's a perfect analogy.
We're completely missing the wind speed, the barometric pressure, the humidity.
Precisely.
Yeah.
You're looking at one dimension of a multidimensional problem. This new framework, the one hitting 92%, it doesn't act as a single algorithm. The way to think about it is actually as a team. It's a team of three experts working in parallel inside the machine.
I like that analogy, a team. Okay, so let's meet the team members. Who is the first expert inside this AI brain?
So expert number one is the Asset Graph Learning Module. Now, in the paper, they refer to this as the Graph Attention Network, or GATE.
JT, okay, so break that down. What is its job on the team?
Think of this as the social network expert.
Like Facebook for the S&P 500.
Very, very similar. This module's core job is to understand that no stock is an island. In the old days, if you were analyzing a stock, say NVIDIA, you'd just look at NVIDIA's chart history.
Right, you'd be in a silo.
You'd be in a total silo. But this module builds a dynamic graph where every single stock is a node. And just like you have friends on a social network, stocks have edges, which are just connections to other assets.
So it's literally mapping out all the hidden relationships. It knows that if NVIDIA jumps, it might pull AMD up with it because they're in the same sector, or maybe it pushes Intel down because they're a direct competitor.
Right. But here is where the attention part of Graph Attention Network comes in. This is the secret sauce. It's not a static map.
What do you mean?
It's not just NVIDIA and AMD are friends, period. It assigns weights to those friendships based on what is happening right now.
Weights? You mean like important?
Exactly. Importance. Imagine you're scrolling your social feed. You see a post from your spouse, and you see a post from some guy you met at a conference 5 years ago.
I'm paying way more attention to my spouse.
Of course you are. The GAT module does the same thing. It uses a mathematical function, specifically a softmax function for anyone who's curious, to calculate an attention coefficient. It decides, moment by moment, which other stocks actually matter to NVIDIA's price movement.
So the friendship status can change. It's not set in stone.
It's constantly changing. It uses a sliding window of recent data. So two stocks might be best friends during a tech boom, highly correlated, moving together, but they might be total strangers during an oil crisis when the market dynamics shift.
And the AI recognizes this shift.
Instantly. And it stops listening to the irrelevant stock, focusing all of its attention on the ones that are actually driving the price movement of your target.
That's fascinating because it mirrors how human traders try to think. We try to understand intermarket relationships, but we can't possibly track 500 stocks and all their changing connections at once.
Our brains just aren't built for it.
We just stick to broad strokes like tech is up or energy is down. This is doing that granular mapping for every single asset in real time.
Exactly. Its main job is to filter out the noise. If a stock over here is moving, but it has no attention weight relative to your target stock, the AI just ignores it. That's the first brain, the social networker.
Okay, so we have the map of connections, a dynamic, ever-changing map. Who is the second expert on the team?
The second expert is the cross-scale temporal modeling module. The technical term they use is the multi-scale transformer.
Okay, transformers, that's the same underlying tech behind things like ChatGPT, right?
The same fundamental architecture, yes. But here, they aren't trying to predict the next word in a sentence. They are predicting the next tick in a price sequence. I call this expert the time traveler.
The time traveler, why that name?
Because it addresses the biggest headache in technical analysis, probably in all of trading perspective.
Oh, yeah.
When you sit down to trade, what chart do you look at? The 5-minute chart, the hourly, the daily, the weekly.
Usually I look at all of them, get completely conflicting signals, and then I just freeze and do nothing.
Which is the human condition in a nutshell. It's paralysis by analysis. The 5-minute chart is screaming buy, but the daily chart is whispering sell. This module is designed to solve that problem.
Oh.
It looks at 3 distinct time windows simultaneously. It has a short-term window that covers 5 steps. Let's just call it 5 days for simplicity. A midterm window covering 20 steps.
Yeah.
And a long-term window covering 60 steps.
So it's like it's wearing 3 pairs of glasses at the same time. One for close-up work, one for mid-distance, and one for seeing way down the road.
And it doesn't get a headache. It processes these 3 separate timelines in parallel pathways. But here's the really genius part. It uses something they call a gating mechanism.
A gate, like it's opening and closing a door.
Think of it more like a volume knob on a mixing board. It decides which time frame is the most relevant right now.
Oh, I see.
So if the market is in a full-blown panic-selling crash, the long-term bullish trend from 2 months ago is completely irrelevant, right?
Yeah, totally irrelevant.
The gating mechanism turns the volume way down on the long-term window and absolutely blasts the volume on the short-term window. It focuses on the immediate chaos.
But if the market is in a slow, steady, grinding bull run,
then it does the opposite. It prioritizes the long-term trend data and effectively ignores the minor daily noise. It adapts dynamically to the market's volatility and character. It doesn't just see time. It understands the context of time.
That is incredibly smart. It solves that constant trader dilemma of being too zoomed in or too zoomed out. Okay, so we have the social network expert seeing all the connections, and we have the time traveler seeing the trends across different horizons. Who is the third and final member of the team?
The third member is the macro-semantic embedding module. I call this one the news junkie.
The one that's constantly doom scrolling Twitter for Fed announcements.
Effectively, yes, but with a processing speed that makes a human look like a statue. This module is really unique because it combines two very different types of information. It creates what they call a fusion.
A fusion of what?
So path one is structured data. This is the easy stuff. These are the hard numbers. GDP growth, CPI, the consumer price index, producer price index, interest rates, the vital signs of the economy that you can just put neatly in a spreadsheet.
Okay, that's simple enough. What's path two?
Path two is unstructured data. And this is where it gets really cutting edge. The study explicitly mentions using large language models. Specifically, they say they use the GPT-4 API to read policy news, government reports, and financial news articles.
So it's actually reading the text. It's not just looking for keywords like inflation or recession.
No, it's reading for comprehension. It digests the policy news and then generates what they call sentiment embeddings.
Sentiment embedding.
It's a fancy term for a numerical vector that represents the vibe of the news. Is this policy announcement scary? Is it optimistic? Is it confusing and creates uncertainty? It turns those abstract human feelings into a concrete mathematical vector that the computer can understand.
And then it just mixes the hard numbers with the news vibe?
Exactly. It fuses them together to create a single macro disturbance vector. This essentially quantifies the overall state and mood of the economy so that the math nerds, the graph and temporal modules, don't miss the big picture.
I see. So it prevents the model from, say, buying a tech stock that looks great on a chart, but is about to be crushed by a new government regulation that just hit the wires.
That's the exact scenario it's designed to avoid. It provides the real-world context.
So you have the social network seeing the connections, the time traveler seeing the trends, and the news junkie watching the economy, and they all kind of vote at the end.
They don't just vote. Their outputs, these complex vectors, are concatenated, basically linked together end-to-end and fed into a final prediction layer. It's a holistic view of the market that, frankly, a human brain just struggles to maintain in real time. We just can't hold that many variables in our head at once.
It sounds incredibly impressive, but a machine needs fuel, right? You can't just tell it, look at the chart. You have to feed it very specific data. Let's talk about the inputs. In the paper, before the graph module can even start building its social network, they have to build an identity for each stock. They call it the feature vector.
This is the DNA of the node. If the stock is a person on the social network, this feature vector is their profile page. It's who they are at that moment in time.
And what's on the profile? What data are they feeding it?
The experts in the study used 13 specific technical indicators.
Just 13. That actually seems surprisingly low for a supercomputer. I would have thought they'd use hundreds.
It's low, but it's very curated. They aren't just throwing the kitchen sink at it because that actually creates noise and can confuse the model. They chose indicators that cover different aspects of price action: momentum, trend, volatility, and volume.
Let's list a few of the big ones so our listeners can check their own charts and see what the AI is looking at.
Sure. So they use RSI, the Relative Strength Index, which is a classic for measuring momentum. Is the stock overbought or oversold?
Standard stuff.
They use MACD, the moving average divergence, to spot changes in the strength, direction, momentum, and duration of a trend. Again, a workhorse indicator.
Classics. Everyone knows and uses those. What else?
Then they have a few that are a little less common in the West. They use KDJ, which is a type of stochastic oscillator used very heavily in Asian markets for spotting short-term trends.
Interesting.
They also use Bollinger Band width. Not the bands themselves, but the width between them. This is a pure measure of volatility. Is the stock quiet and coiling, or is it exploding in price? And very importantly, they use OBV, or on-balance volume.
Okay, OBV. Why is on-balance volume so important here?
Because price tells you what happened, but volume tells you the conviction behind the move. OBV is a running total of volume. It tracks the flow of money in and out of the stock. By including this, the AI knows if a big price move is a fake out on low volume or if it's backed by real institutional money.
It's like a lie detector test for the price action.
It's a great way to put it. It separates the signal from the noise.
And the study mentions they handle data hygiene pretty strictly too, right? They don't just dump raw data in.
They absolutely have to. Garbage in, garbage out. They use a sliding window mechanism to ensure the AI is always looking at the freshest data, just like a human trader would. And they use a technique called forward filling for any missing data points.
What does that mean, forward filling?
It just means if a data point is missing for, say, Tuesday, the system assumes it's the same as it was on Monday until it gets new information. It keeps the timeline clean and unbroken so that the time traveler module doesn't trip over a gap in the data.
Okay, so the machine is fed with clean, curated data. The team of experts is working. Let's get to the part everyone really wants to hear, the showdown. How did this thing actually perform?
So the headline stat, as we mentioned, is at 92.4% precision in classification tasks.
Can we pause on that word precision for just a second? I want to make sure we're being technically accurate here for everyone listening. What does precision specifically mean in this data science context?
That's a really good catch because it's important. In data science, precision is different from accuracy. Precision in this specific classification task means of all the times the AI predicted the market would go UP, how often did it actually go UP?
See.
So it captures the reliability of the buy signal. It means when this model pulled the trigger and said go long, it was right 92.4% of the time.
That is just incredibly high. That basically means if you only took its signals, you'd be right more than 9 out of every 10 times.
It's a quantum leap. And to really understand why that's so impressive, we have to look at what it was competing against. They pitted this model against some of the established heavy hitters in the AI trading world.
Okay, let's visualize the matches. First up, the new framework versus LSTM. That's long short-term memory. Now, LSTM has been the golden child of AI trading for a few years, right?
It absolutely has. LSTM is a type of recurrent neural network, an RNN, and it is fantastic at remembering the past. It's specifically designed to look at a sequence of data, like a stock chart, and remember long-term dependencies. But it has a fatal flaw.
And what's that?
Tunnel vision.
Tunnel vision.
LSTM treats every single stock as an island. It looks at Apple's history to predict Apple's future. It looks at Google's history to predict Google's future. It completely ignores the social network we talked about.
So it doesn't know that Microsoft just released a product that directly competes with an Apple product.
It is completely blind to the rest of the market. It has no context.
So the new framework wins that matchup because it sees the connections between the assets.
Exactly. The graph module just destroys the LSTM of performance because it understands the context of the entire market, not just the isolated history of one asset. It sees the web, not just the spider.
Okay, that makes sense. So next match. The new framework versus stock GCN. Now, stock GCN is a graph convolutional network. So this one does see the social network, right?
It does. It's built on a graph structure, so it sees the relationships. But stock GCN is often too rigid. It sees the network, but it lacks that sophisticated time traveler ability we talked about.
The multi-scale transformer.
Right. It doesn't have that.
Yeah.
It can't dynamically zoom in to the 5-day window or zoom out to the 60-day window as effectively. It's kind of stuck at one level of magnification.
So it's like having a map of your friends, the graph, but not knowing if they are your friends right now or if they were just your friends last year.
That's a great way of thinking about it. Or not knowing if you should be paying attention to their behavior today versus their behavior over the last month. The new framework wins because of that multi-scale attention. It knows when to look at the network and when to look at the trend history. It has that dynamic focus.
Now, this part of the paper I found really fascinating. They did an ablation study.
The remove apart test. My favorite part of any good AI paper.
It's basically like they started removing parts of the AI brain to see what would happen, like taking a car engine apart piece by piece to figure out which part actually makes it run.
This is where you find out what really matters. It's how you separate the essential components from the nice-to-haves.
So what did they find? Which of the 3 experts was the most critical?
This was surprising to some people, I think. When they removed the temporal module, our time traveler, the performance dropped the most. By a lot. The F1 score, which is a combined measure of precision and recall, fell all the way to 87.2.
Wow, that's a huge drop compared to when they removed the other modules.
It is. And the takeaway here is profound. You can have all the fancy social network graphs, you can have GPT-4 reading the news, but at the end of the day, simply knowing what happened yesterday, the pure, unadulterated time sequence, is still the single most important factor in predicting what happens tomorrow.
Trend is king.
Trend is king. The fancy stuff helps you refine the edge, it gives you that extra percentage point, but the core of prediction is still temporal. It's about history.
That is a great reality check. It grounds all this sort of sci-fi tech in the absolute basics of trading. Speaking of reality checks, we have to be fair. This paper isn't just a victory lap. They're good scientists, and they list their own limitations. What is wrong with this model? What are its weaknesses?
The biggest critique, and the authors admit this right up front, is what they call the tighter coupling issue.
Tighter coupling. Okay, explain that.
So right now, the three brains, the three experts, they work in parallel. The graph brain does its thing, the time brain does its thing, and the macro brain does its thing. Then, at the very end of the process, they just glue the answers together. The technical term is concatenation.
So they aren't really talking to each other during the process. They're working in separate rooms.
Exactly. The graph brain isn't whispering over to the time brain, hey, because this network connection just got super strong, you should probably focus on the short-term window. They are siloed until the final vote.
I see.
The authors say future versions need joint optimization. They need to learn together in real time, not just vote together at the end. Their learning processes need to influence each other.
That makes perfect sense. It's the difference between a team that collaborates on a project in the same room versus a team that just emails their separate reports to a manager at the end of the day.
That is a great analogy for it. And the second major limitation is the real-time gap.
We touched on this a bit. They used GPT-4 for the news module.
Yes. And while GPT-4 is amazing at understanding text, it has latency, there's a delay. And the authors admit they didn't fully exploit high-frequency data sources like, say, the Twitter fire hose or real-time analyst reports being published. They were mostly looking at daily policy news.
Right.
In the world of high-frequency trading, or HFT, where decisions are happening in microseconds, reading yesterday's news or even news from an hour ago is an eternity.
So it's still a bit slow on the news front compared to a human trader glued to Twitter or a dedicated news scraping algorithm.
Precisely. It's an incredibly powerful model, but it's not quite live in the way a true microsecond trader would need it to be.
Okay, so that's the cutting edge science. That's what's happening in the lab. But our listeners are sitting at their desks or on their phones right now. They can't just download this source code from the journal and run it unless they have a sophisticated Python environment and a whole rack of GPUs.
No, this is not a consumer product.
So let's pivot. Let's look at the tools that exist today in 2026 and see how they stack up against this 92% monster from the lab.
This is the practical application part. We've reviewed the current landscape. We looked at Tickeron, TrendSpider, interactive brokers, even workflow tools like Monday.com. These are the companies trying to bring this level of power to the retail investor.
Okay, let's start with Tickeron. We see this name a lot in the AI trading space. How does it connect to the paper?
Tickeron is interesting because their approach is probably the closest in spirit to the structure of the academic paper we just discussed. They use what they call financial learning models, or FLMs.
Which already sounds a lot like the deep learning framework.
It does, and their key feature, the one they market heavily, is real-time patterns, or RTP. The AI scans for 33 specific chart patterns, candlesticks, triangles, head and shoulders, you name it, and gives you a confidence score on the outcome.
Okay, but what's new? How does this connect to our paper?
The 2026 update is what really connects them. They recently shifted their analysis cycles from 60-minute intervals down to 5-minute and 15-minute cycles.
Ah, there it is. The high-frequency granular data.
That's it exactly. The academic paper proved that using high-frequency, more granular data improves precision. Tickeron clearly saw the same thing and implemented it. By analyzing data every 5 minutes instead of every hour, they're trying to catch those same micro trends that the time traveler module in the paper would be looking for.
And what about the numbers? I saw some pretty wild claims in the reviews we looked at regarding their performance.
They are bold, no question. They claim annualized gains of over plus 204% on certain AI-driven strategies involving NVDA using these new shorter cycles.
204% annualized.
Now, we have to be really careful here. That's annualized gains on a back-tested or simulated strategy, which is a very different metric from the 92% precision of the paper.
Right, different things.
You can have incredibly high gains with a much lower precision rate if your winning trades are big enough to cover all the small losers. But what it does show is that applying AI to high-frequency data is generating significant alpha in the retail space. It validates the core concept of the paper.
So Tickeron is sort of like the pattern recognition and time traveler brains combined. What about TrendSpider? I've always thought of them more as a high-end charting platform, but they've gone heavy into AI lately.
TrendSpider has taken a very different but equally interesting approach. They are leaning into the generative AI edge. Their standout feature for 2026 is the AI coding assistant.
This is for the trader who has a great idea for a strategy but doesn't know how to write a line of Python, right?
Exactly that person. In the academic paper, the researchers had to manually code all those complex inputs, the 13 technical indicators, how to combine them into a feature vector. TrendSpider recognizes that regular people can't program in Python or their proprietary scripting language.
So what do you do?
You just type. You can literally type into TrendSpider, create a volatility-based stop loss that tightens when the market drops, and the AI writes the executable code for you.
That is huge.
Oh.
So it basically allows a regular user to generate those same complex feature vectors that we talked about from the paper, but just by using natural language processing.
It completely democratizes the input section of our deep dive.
Yeah.
You don't need a PhD in computer science to build the features for your model anymore. You just need to know what you want to ask the machine to do.
Now, let's talk about a buzzword that is absolutely taking over 2026, agentic commerce. We saw this in the Monday.com review and just in the general tech landscape. What does this mean?
This is the fundamental shift from tools to agents. A calculator is a tool. You have to sit there and press all the buttons. An agent is an employee. You give it a high-level goal, and it figures out the steps to get the work done.
So instead of help me calculate the risk on this trade, it's more like watch this stock and alert me if its risk profile changes based on breaking news.
Exactly. And tools like Monday.com's Agent Factory are letting people build these. You can hire a bot, an agent, to watch earnings reports for you, or to go out and summarize all the macro news for the day.
Wait a minute, summarizing macro news. That sounds exactly like the macro semantic embedding module from the paper.
It is. That's the News Junkie module coming to life for the average retail user. And the core technology that's making all of this possible now is the Model Context Protocol, or MCP.
Okay, we definitely need to unpack MCP. What is it?
Think of MCP as a universal translator, or maybe a USB port for AI. It's a new standard that allows a large language model like Claude or Gemini or GPT to plug directly into a live data feed.
Like Alpha Vantage or a brokerage account.
Precisely. Before MCP, the AI was effectively trapped inside a chat box. It couldn't see the outside world in real time. With MCP, the AI can reach out on its own, grab the live market data, analyze it, and then come back to you with an insight.
So MCP is the plumbing that connects the brain to the market.
Yes. It is the critical piece of infrastructure that makes the macro semantic module from the paper actually possible for a retail trader. You can now have your own personal agent reading the news and correlating it with your portfolio in real time.
That is an absolute game changer. It means you can build your own specialized little agents to do your bidding. Okay, one more tool to cover. The big one. Interactive brokers, IBKR. They're the heavyweights in the brokerage world. What are they doing with AI?
So IBKR has the iBot. It allows for natural language commands for trading and analysis. Chart Apple versus Microsoft, buy 100 shares of Tesla. But the contrast here is really important.
How so?
The academic paper is laser focused on prediction guessing where the price is going to go next. IBKR, for the most part, uses its AI for execution and workflow.
So it's not telling you what to buy, it's just helping you buy it better and faster.
Exactly. Find me the best price for this order. Route this order to a dark pool. Show me my real-time risk exposure across all my positions. It's using AI to make the human trader faster and more efficient, rather than replacing the human's core decision-making process. It's an efficiency play, not a prediction play.
Okay, so we really have a whole spectrum of tools here. We have Ticker-On doing pure prediction with patterns. We have TrendSpider helping you build the code for your own ideas. We have these new agents reading the news for us via MCP. And we have IBKR handling the slick, fast execution.
And if you think about it, if you were to put them all together, you essentially have a DIY consumer-grade version of the framework in the paper.
You can build your own team of experts.
Exactly. You are the architect now. You hire the pattern expert from Ticker-On, you hire the coding expert from TrendSpider, and you hire the news agent built on the MCP protocol.
So let's try to synthesize all of this. We started with this incredibly dense academic paper that proved mathematically that if you combine a social network graph, a multi-scale time traveler, and a macro news junkie, you can hit a 92% accuracy rate.
Correct. And the math proves that the combination is the key. Isolation is failure. If you're only looking at one of those three things, you are losing.
And then we looked out at the actual market of tools and we realized that while we can't buy that exact single algorithm, all the pieces are now available. The retail market is catching up by giving us agents and tools that can handle these separate tasks.
TrendSpider can be your graph and time tool. Tickeron is your pattern tool. And these new LLMs and agents are your macro tool. If you aren't using all three of those angles in your analysis, you're essentially trading with one hand tied behind your back in 2026.
That's the practical takeaway for everyone listening, but I want to leave our listeners with a more provocative thought, and this comes all the way back to the black box problem we started with. The academic paper achieved its 92% accuracy by, in a way, ignoring the human element. It treated stocks as cold mathematical nodes. It treated news as vector embeddings. It treated history as data points. It filtered out the noise, which is us, the humans, our fear, our greed.
Yes, it stripped away the emotion to find the pure signal.
But here is the question. As we all start to adopt these tools, as every retail trader starts using an agent to read the news and a bot to watch the graph for them, are we becoming the macro factor for the AI?
That's a fascinating thought. You mean our collective behavior becomes just another input for the model?
Exactly. If everyone starts using these agents, does the very noise that the AI was designed to filter out actually become the market itself? If the AI predicts the price will go up, and then we all follow the AI and buy.
Then the AI isn't predicting the market anymore. The AI is the market.
Yes.
And that creates a bizarre feedback loop that no amount of historical data, no matter how deep the LSTM looks into the past, can possibly predict.
We might be entering a world where the algorithms are just trading against each other's predictions of each other's predictions.
The ultimate hall of mirrors. A world where the fundamental value of a company might matter less than the attention weight assigned to it by a million different graph networks all watching each other.
A chilling thought, but also an exciting one. It means the game is changing at a fundamental level, not ending. And on that note, I really want to encourage you, our listener, to look at your own trading stack. Do you have a graph tool that sees connections? Do you have a time tool that sees trends? Do you have a macro tool that sees the world? If not, you might want to look into that before the robots leave you behind.
So definitely. Don't be the liquidity the AI sweeps up. Be the one using the sweeper.
Thanks for listening to The Deep Dive. We'll catch you next time.